All right, let's get right into it. If you want to understand what's really moving global markets right now, you have to follow a very specific chain of events. And believe me, it all starts with one thing: energy.
This quote right here, this is the key that unlocks the entire market landscape today. Seriously, it's not about waiting around for the next inflation print anymore. It's about watching the price of oil. That's the mindset we have to be in.
So, first things first, we've got to identify the primary driver of this market. And right now, there's no question. That driver is unequivocally energy. You'll see that everything else is basically just reacting to what happens there.
This framework is really the best way to think about it. Cautious, led by energy, and super sensitive to what Treasury yields are doing. It explains perfectly why we're seeing certain assets move in lockstep and what's really causing all the pressure on global markets. It all just fits together.
Now let's look at how this pressure actually moves through the system. It's not random at all. It's a really clear sequential domino effect that we can trace, step by step, from oil all the way down to equities.
So here it is. This five-step chain is the engine running the whole show. It kicks off with an energy shock, which of course feeds right into inflation fears. That in turn pushes Treasury yields higher, which then strengthens the US dollar, ultimately creating this really fragile environment for stocks. See the chain?
Okay, so let's break that down even further. We're going to look at each one of those dominoes in the chain to see exactly how these different asset classes are reacting to the pressure.
And it all starts here, with oil. Prices are staying stubbornly high, not because of some huge surge in demand, but because of these persistent geopolitical supply concerns. This is the very first domino to fall.
And this number really illustrates the pressure point. With Brent crude holding strong right around that critical $103 level, it's basically keeping the entire market on edge.
So here's the bottom line. As long as these supply risks are keeping energy prices this high, that pressure is going to feed directly into the next link of our chain. Those inflation expectations and, you guessed it, Treasury yields. Now, higher energy prices and the inflation fears they bring, well, they're pushing Treasury yields up. The best way to think of yields is as the main transmission mechanism. They take the pressure from the energy market and just blast it out to all other financial assets. The 10-year Treasury yield, hovering around 4.2%, yeah, that is a huge deal. It's not just some number on a screen. It's actively tightening financial conditions, making it more expensive for everyone to borrow money. And that affects, well, everyone.
So what happens when U.S. Treasury yields are high? Simple. It makes holding U.S. dollars way more attractive. You combine that with a general risk-off mood in the markets, and what do you get? A very, very strong U.S. dollar.
And look, this dollar strength isn't just an FX story. It creates a massive headwind for international companies, for emerging markets, and for any commodity that's priced in dollars.
And here we are at the final domino in our main chain, equities. The direct consequence of higher energy costs, higher yields, and a stronger dollar is some pretty significant weakness for the stock market. You can just feel that sentiment is under pressure.
We saw this play out so clearly in Friday's session. All the major U.S. indices closing in the red just confirms that this macro pressure is taking a real toll on risk assets.
But here's where it gets interesting. We're seeing a real divergence in the alternative assets. Gold, which you'd think would do well in this kind of environment, is actually getting pinned down by that strong dollar and those high yields. Meanwhile, Bitcoin is showing some remarkable stability, holding firm above that key $70,000 level. Maybe it's acting as a different kind of hedge.
So, if we put all of these pieces together, what does the current risk landscape actually look like? Let's take a look at a quick snapshot.
This risk map gives us a really clear summary. The main drivers, oil, yields, and the dollar, are all pushing up. The main victim, equities, is trending down. And then you have our wildcards, gold and Bitcoin, kind of caught in the middle. Okay, so given this really clear chain of command, the most important question for any trader or investor is pretty simple. What could actually change this story? What's going to be strong enough to break the chain? You've got to keep a close eye on these four areas. Any big change in Persian Gulf energy supplies, a sudden drop in yields, a big reversal in the dollar, or maybe a surprising reaction from equities. Any of these could ripple through the entire system and completely change the game. So the key takeaway is pretty straightforward. Keep monitoring this causal chain. It all starts with energy. That pressure is transmitted through yields in the dollar, and for now, Bitcoin is bucking the trend while stocks are the ones feeling the heat.
And really, that's the central question, isn't it? We know the sequence, we know the pressures, but what's the catalyst going to be that's finally strong enough to break it? That is what everyone will be watching.